The IRS has issued the broker regulations related to digital assets. That's what I want to go over in today's video. What do the regs look like? What are changes from the proposed regulations? And what do you need to plan for from a tax perspective as an investor or a business that's transacting in digital assets? So if you want to learn more about the broker regulations and the 1099 DA, this is the place to learn about that. So let's get right into it. Firstly, I think that the changes that we've seen from the proposed broker regulations to the actual regulations, we have seen some improvements. We have seen the IRS, to a degree, take into account some of the comments that they've received during the comment period from last summer with the proposed broker regulations. But there are still a lot of complications that these regulations are going to cause for taxpayers. And there are still some open-ended considerations that we're going to have to sort of see how they play out in the future with future regulations. So to get into some details, the first and most important aspect of this is that the rules and the application of these regulations to non-custodial providers has been delayed. So the proposed broker regulations were defining non-custodial providers such as Uniswap, for instance, basically, front-end software wallets, RPC wallets, L2 sequencers, liquidity providers. If anyone is effectuating a transfer, even if this is, a decentralized application, to a large degree, if they're affecting a transfer, if they could affect fees on the back end, then they were going to be included in these proposed broker regulations. So this would have included, like I said, DEXs like Uniswap and others similar to them. So this has been delayed. Right now, non-custodial providers are not being included in the regulations. So these are going to be targeted more towards centralized exchanges for the time being. But in the final regulations, the IRS has reserved the use of this definition to apply to non-custodial providers. They said in this report that they do not agree that non-custodial industry participants should not be treated as brokers, and they intend to expeditiously issue final regulations for non-custodial actors. So it basically seems like, they've been excluded for the time being, but this seems like something that they're still going to include in the future. We've already covered the implications to this, the reporting implications, the possible implications to some companies, geo-gating out US participants if they don't want to deal with the data collection. So we're going to have to see where this goes. At least for the time being, we're not going to see non-custodial providers included in this. Another big adjustment we've seen with the final regulations is regarding stablecoin reporting. So originally, all stablecoin transactions were going to be reported on 1099s, DAs, and now that's been condensed to sort of streamline the reporting requirements here. So if you exchange a stablecoin for another digital asset, those are going to be not reportable right now. And the logic behind that most likely is that, they're very similar to if you're on ramping USD into that digital asset. If you trade stablecoins for assets or services, other than digital assets, then they're going to have to be reported if they're over 10K per year. So this consolidates some of the reporting requirements related to stablecoins. So I think that this is a positive development. Additionally, in terms of, sort of cutting down the filing requirements, there's also certain types of transactions that are going to be excluded. But I want to note that these transactions have been noted that they're going to be excluded pending further study. So these may be included in the future. Right now, they're not going to be included. That includes wrapping and on-wrapping, liquidity provisions, liquid staking, lending with obligations to return the same asset that was borrowed, short selling, and other various transactions that are similar to those. I don't have an exhaustive list here. So with these transactions being excluded, again, it's going to report down on the overall reporting requirements. So I think this is positive, but we're going to have to see if these are going to be included in the future. Additionally, some of the information has been cut down to what has to be reported on the 1099 DA. So the time of the transaction ID, and the customer's blockchain address are no longer to be reported. Now, the reporting companies have to retain this information, including the transaction ID, the blockchain address, for up to 7 years. So they're still going to have to collect this information. They're going to have to retain it in their permanent documentation, but it's not going to get filed specifically on Form 1099 DA, at least at this time. Another step that they've taken towards consolidating the reporting requirements is related to NFTs. NFTs are still treated as digital assets, but there's thresholds to where NFTs do not have to be reported. So if the NFT transactions don't exceed $600, they don't have to be reported. If there's NFTs that do have to be reported, they can be reported on an aggregated basis. So rather than having to report each individual transaction of an NFT, you're going to be able to either not report them if they're under this threshold or report them on an aggregated basis. Obviously, this is going to cut down on filing requirements. We're not going to have to file a 1099 DA for every NFT that you mint for $1. We'll be able to aggregate these, or if they're below the reporting threshold, we don't even have to report them in that case. So I thought that that was another positive development related to this, because these are all good steps that are being taken to just reduce the overall filing requirements and paper that's going to be filed. Now, one of the biggest aspects to note about the proposed broker regulations, outside of what I've already covered, is the accounting method. So the broker regulations have made something clear that I've been harping on for a long time that's been overlooked industry-wide. Now this has been acknowledged with the broker regulations, and it's been acknowledged by the IRS. Taxpayers, according to how the Form 1099 DA is going to be filed, and according to the IRS, are going to have to default to using the FIFO accounting method, which is first in, first out accounting method. The only time you can use specific identification is if you can specify which units of a digital asset that you're selling. And this has to be done at the time of the sale date. What I see a lot of people do is they'll be trading across a variety of non-custodial wallets and exchanges, and they'll be commingling together, a fungible cryptocurrency. And then a year passes and they're doing their accounting, and they'll go into a tax software, plug in all of their transactions, choose HIFO, cherry pick the highest cost basis, and go and report that to the IRS. Oftentimes, when they choose HIFO and they're picking out that highest cost basis, the cost basis that they're picking doesn't match the actual flow of funds across exchanges and wallets. Your highest cost basis may have been an Ethereum that you purchased on Kraken, and now you're saying that you sold that on Coinbase, but you never in fact performed those transfers and moved those funds accordingly. And additionally, you may have not specified, and you most likely haven't specified to your broker which Ethereum you want to sell, if there's multiple Ethereums that are in that account that you're selling out of. So ultimately, you cannot go and try to claim specific identification if the documentation that you're providing for your accounting records is not going to match your flow of funds on chain and across exchanges. And you need to be able to specify which asset you're selling at the time of sale. Now, at Camuso CPA, what we recommend clients to do if they want to apply specific identification to certain assets is to segregate their tax locks into different non-custodial wallets. If you've been purchasing Ethereum over 5 years, purchases that you made in different tax lots, you could have put those in different wallets to segregate the cost basis associated with each one of those purchases. Obviously, most people aren't doing this. Most people are doing what I said. They're transacting across multiple wallets, multiple exchanges, jumbling everything together, and then usually going into an accounting software, choosing HIFO, usually picking HIFO across the board for their whole portfolio, and just cherry picking the best cost basis, and it doesn't match their flow of funds or their actual fact pattern related to what is going on chain. So this is going to be a huge issue. And the IRS is aware of it. That's why they've come out with Revenue Procedure 2024-28. This was issued with the final regs, and it's going to provide transitional rules for taxpayers who've previously applied this multi-wallet approach for determining tax lots sold. So this is 2004-28 is going to be something that is released on July 27, 2024. So we're going to be looking at that in more detail. Expect to see more videos on that. But this is an important consideration for someone that may be contemplating what accounting method they're going to use. I've seen tons of tax software companies and even CPA firms really promoting using HIFO and Spec ID in a manner that is not going to be sufficient for tax and audit purposes. So this is something that you really want to stay on top of and make sure that you are applying the correct accounting method, that you're managing your funds on chain appropriately as well. And to whatever degree that you want to use Spec ID, you should be segregating those tax lots. So these are the big changes related to the broker regulations for digital assets. As you can see, there's been some positive developments here, but there's going to be more changes in the future, and some of those changes could impact a large part of our industry. So we're going to continue to keep an eye on this. Now, if you're an investor that's hearing about the 1099 DA and you're realizing that you may need to go and clean up your accounting to make sure that you're in compliance, maybe it's related to your accounting method, maybe it's just related to your reporting in general, that's something that we can help with at Camuso CPA. Similarly, if you're a Web3 business that is going to have to deal with these reporting requirements, either as a taxpayer that's receiving the forms or as a custodian or a broker that may be having to file these forms on behalf of your customers, that is also something that we can help with at Camuso CPA. Our digital asset accounting experience and tax experience is unrivaled in this industry. So if you have questions or you want to discuss this further, feel free to reach out to me and my team today at CamusoCPA.com. I'd be happy to sit down with you, understand your business and your portfolio, and see how me and my team can assist you. So contact me today at CamusoCPA.com. Until next time, I'm Patrick Camuso, signing off.